Welcome to the show, where you'll learn how to invest in mortgage notes, the savvy real estate investor's secret weapon to create cash flow without tenants and property acquisitions for pennies on the dollar. My name is Robert Haitha, founder of Fixed Notes, and my mission is to make note investing ethical, profitable, and accessible for you. In every episode, we're democratizing the industry to put these powerful Wall Street assets into the hands of Main Street investors like you. So without further ado, let's get into this show where you're in good hands with my AI clone. Let's go. This program is for informational purposes only and should be independently verified before taking action. Loan amortization is the process by which debt is paid down over time through regular payments. In a fully amortizing loan, each payment includes a portion that goes to interest and a portion that goes to principal. Early in the loan, most of the payment covers interest. As time passes, the interest portion shrinks, and more of each payment reduces the principal. For note investors, this directly affects cash flow, valuation, and resolution strategy. Let's say you're reviewing a performing loan, $100,000 at 6% interest over 30 years. That monthly payment is around $600. In year one, about $500 of that is interest. It's not until years down the line that you see real principal paydown. So if a borrower's been paying for 10 years, the balance might still be $80,000 or more. You can't assume equity just because they've been in the loan a long time. You need the amortization schedule to know where they really stand. That matters in due diligence. Say you're buying a reperforming note. The borrower is back on track and the payment history looks decent. But if most of the principal is still unpaid, your investment is exposed longer and your cash flow is mostly interest income. That might sound great, but it also means your break even is farther out. If the borrower defaults again, you're left holding a balance-heavy loan with less recourse. Now let's talk workouts. If you're modifying a loan or offering a payment plan, amortization impacts what the borrower can afford and how quickly you recover capital. A 20-year amortization will give you better cash flow than a 40-year one, but may be harder for the borrower to stick with. You have to balance long-term yield with short-term resolution. A loan that amortizes too slowly ties up capital. One that amortizes too aggressively may lead to another default. The schedule helps you find the sweet spot. Amortization is also key when you're dealing with partials. When you sell a partial, the investor isn't simply stepping into the borrower's original amortization schedule. Instead, the partial has its own amortization, structured so that the partial buyer receives a fixed return over a set number of payments, say 60 months. Even though they're receiving the borrower's full monthly payments during that period, the partial investor gets their full principal and interest back by the end of their term, regardless of where the borrower is on their loan's original amortization curve. That makes it essential to model both schedules correctly so you know exactly when the reversion happens and what remains of the note at that point. The key is to systematize it. Use a calculator. Build it into your underwriting process. Every time you look at a note, plug in the terms. Make sure your team does the same. If you're not modeling the amortization curve, you're guessing at yield, and that's not how professional investors operate. Next episode, we'll go deeper into collateral value because all the amortization in the world won't help if the property behind the note isn't worth what you think it is. Understanding the asset is just as important as understanding the loan. Thanks for sticking around to the end, and thank you to my trusty Robot and the Fixed Notes team for putting together another episode. If you want to learn more and hang out with the real, not AI version of me, join our free school community at school.com/fixnotes. That's SKOOL.com/FIXNOTES. In the meantime, we'll see you in the next episode.